Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors in Hilton Head. I'm also the host of Money Matters here on WHHI TV. Today we have a really exciting show. We're going to be talking to Mark June from June & Associates CPAs in Hilton Head about tax trends and tax strategies from 2010, 2011, and looking towards 2012. We're really excited about the show. Hope that you'll stay with us. It'll be very interesting. But before we get to Mark, I'd like to talk to you a little bit about a few market trends that are occurring in the financial markets in our Market Minute. And we do have some interesting news from around the world. First and foremost, of course, last week we did hear from Fed Chairman Ben Bernanke looking at a relatively lackluster report going forward for the next quarter, which I think is showing that we have continued unemployment, relatively low interest rates going forward. In addition to that, we've also heard that the Greek debt is likely going to be downgraded yet again. Right now they're looking at interest rates somewhere in the neighborhood of 17%, so it's likely that we're going to see a Greek default on debt in some form going forward. In addition to that, we've also heard from China that China's GDP is continuing to grow at a rapid pace. Because of that, we expect that the Chinese government is going to increase Chinese interest rates or interest rates in China, which should probably begin to slow the Chinese market as well. So by and large, we're looking at a continuing trend across the globe, pretty much of a continued slowdown, which is somewhat what people have been expecting. And then lastly, on more of a positive note, while it might sound not so positive, we're expecting to see commodities, because of this slowed growth, start to roll over somewhat and start to see a slowing in the, if not a reversal in the value of commodities such as oil, silver going forward, which actually should prove to be more of a benefit for the economy. So we're looking forward to that. And we'll see how it plays out. That's pretty much it for our Market Minute. In a few minutes, we're going to be joined by Mark June to discuss our tax strategies and trends going forward. But before that, please welcome David Kroll in our Mortgage Minute, and I'll be back in just a few minutes with Money Matters. Thanks very much.
This is David Kroll from Mortgage Network, here to talk to you for the Mortgage Minute. Rates remained stable this week. Fixed rates in the 4s, adjustable rates in the 3s. Storm clouds are brewing. We are expecting rates to move slowly but steadily up over the coming months. Now is the time for each and every one of you that have existing mortgages. Over 52% of all households have still not refinanced into this 35-year low. Now is the time for you to come in, take advantage of the low rates, and come up with a financial plan. Thank you very much. That's my message for the week.
Welcome back to Money Matters. I'm Emily Johnson, and I'm joined by Mark June of June & Associates CPAs in Hilton Head. Mark's here today to talk to us about some trends in what you're seeing in tax returns and that type of thing. So actually, before we get started, could you tell me a little bit just about your practice, the kind of clients that you see and that type of thing?
Sure, I'd love to, Emily. We're a full-service CPA firm here on the island. We have 4 CPAs, 3 bookkeepers.
Wow.
We perform payroll, audit, review, tax work, tax advisory work.
Everything.
So pretty much the nuts and bolts of all the CPA stuff.
So you're busy all year round?
All year round.
All year round.
Yep.
That's a good way to be.
Definitely like to stay busy.
What, given that, what kinds of trends did you see now that you've kind of passed the hot season of the 2010 tax returns? Like what kind of trends did you see in your clients' returns this year that may have differed from other years?
I would say in this economic climate, it's been tough. Mm-hmm. A lot of real estate issues where you're getting short sales and forgiveness of debt income items, and mm-hmm. But I see some specific items that I see more routinely happen to certain clients.
Mm-hmm. Such as?
Investment fee deductions.
Okay.
You see
people
a lot of
forgetting
people,
that?
Retirees around here that have investment fees that are paid out of their IRA accounts. Mm-hmm. Aren't deductible if they're paid out of the account themselves.
Good point.
So they need to be taken out of a taxable account or be invoiced separately.
Mm-hmm. So somebody should ask their advisor to take those out of their taxable accounts as opposed to their IRAs?
That's correct.
Okay.
That's correct. Another hot item last year was the Roth conversion. They raised the bar as far as what qualified for doing a Roth conversion, and there's a lot of benefits for having a Roth IRA as opposed to a regular IRA. And there was a 2-year deferral in 2010. That's gone, but you can still do Roth conversions going forward. And I find that to be an excellent tax planning tool for anyone going forward, especially people who don't necessarily need the required minimum distributions as taxable income. It's a way to get rid of that. It's a way to kind of continue with the growth of the retirement account.
So probably, you know, higher assets, higher income, they have the cash on hand to be able to do the conversion, to make the conversion and pay the taxes out of cash flow? Yeah,
definitely. There's definitely a lot of criteria that one would have to go through to make sure a Roth conversion is right for you. It's not a one-size-fits-all by any means. But it's a very effective planning tool.
Anything, you know, any other trends that you saw in terms of savings? I mean, people putting more money into IRAs or taking more money out of IRAs than traditional years?
Unfortunately, we see more people taking early withdrawals out of IRAs, and usually the conversation starts coming around to, if I'm below the age 59 and a half, it's subject to a 10% penalty.
Right.
And there are certain exclusions that could not assess the penalty to somebody. Most people don't qualify for them, but they are out there.
And do most people, are they aware of those exclusions, and also are they aware of the 10% penalty when they're doing it, or do you usually see it and they come to your office and say, well, I did it, I took those funds out, or do they, you know, are they most people aware of those exclusions?
I think it's, you know, the reply I get is, it is what it is.
Right.
You know,
I know.
I needed the cash to live on, and this is what happened, and you know, you're the bad guy for telling me what the actual outcome is. So I think some of them knew, some of them didn't know, but at the end of the day, they did what they had to do to kind of make ends meet.
And wasn't last year the last year too for, or maybe it'll extend it this year, but for the charitable contributions? Yeah,
the qualified charitable distribution. They did extend it. It is in 2011.
Okay.
And it allows someone to take direct IRA distribution to a qualified charity. It lowers your taxable income, and you don't get a charitable contribution with it, but it's an effective way for especially someone who doesn't itemize. They can lower their taxable income, have a lower tax bill, and yet be giving to the same charity they were probably already giving to.
Sounds like good planning.
Yeah, that's a great plan.
I mean, are there any other sort of hidden tax benefits that you feel like a lot of people don't take advantage of, or that you were sort of, you saw more people taking advantage of in 2010, or that you were suggesting?
Well, one thing I see that a lot of people don't get is in South Carolina specifically, we have a homeowner's insurance credit. And basically, if your premium's greater than 5% of your adjusted gross income, it's a credit against state tax.
Okay.
And with income levels kind of going down, premiums and insurance either went up or stayed the same. A lot of people are qualifying for it, but they don't know about it. And it's not a refundable credit, but it certainly offsets our state tax. And it's a credit I would say I see missed a lot.
Really?
Yeah.
Well, what about with regards to income? I mean, are more people taking, I know a lot of my clients anyway, I'm seeing that they're diversifying their income. Some may be going back to work, you know, to supplement investment income because of a fear over lower income coming from their investments, you know, fears over taking capital gains, that type of thing. I mean, did you see any trends in diversification of income among your clients?
To me, there's still quite a few people that haven't overcome the shock of the 2008, 2009 kind of market scare.
I agree with that.
You know, I had some people cash out. They kind of sat on the side. They missed the recent run up, and now there's this scare of the market going back down and talk of this double dip recession.
Yep.
And so there's this hesitation, I think, of actually getting into the equity market. People are looking at bonds. Now they're hearing about a lot of scare of the bond market and how solid is that. And so people are kind of, they're scared. You know, they're afraid to make the investments. They know they have to be out there. So I think a lot of people have a lot of cash parked in banks, which of course, you know, they're not paying much now anyways.
Right, so they might have to supplement that income.
Yeah, definitely.
At some point.
Definitely.
Well, that's actually really interesting. That pretty much jives with what we're seeing in the investment market too.
Is it?
So, yeah. Well, thank you very much. In just a second, we're going to need to take a quick break, but in just a second, we'll be back with Mark June to talk about tax strategies that we might want to take advantage of for the 2011-2012 and some different proactive strategies. So thank you for joining us with Money Matters, and we'll be right back. Welcome back to Money Matters. This is Emily Johnson. I'm joined by Mark June, and we're here for our second segment of Money Matters today, where we're going to be talking more about proactive strategies that we can take in uncertain markets. So I know that I've seen a lot of uncertainty in the financial markets. I know there's a lot of uncertainty in tax code and that planning as well. What are some of the responses to that uncertainty, or how are you helping plan with that uncertainty in mind?
Well, one of the unique things about the uncertainty that I see is what I call the one spouse syndrome. Typically I deal with the male counterpart when it comes to a couple, and the wife just generally has no interest in taxes or the paperwork. And unfortunately I've seen situations where no one plans their demise, but now I have the spouse coming in the office and she really has no idea what to do. And depending on situations, sometimes situations get pretty complicated with multiple trusts, multiple brokerage accounts.
Yeah.
And I've seen it happen more times than one on just spouses have no idea what's next.
Now, do you try to help them compile all that data, or who do you work with in your team to kind of bring all that together?
Yeah, well, we have to work with the broker. Typically, they have an estate attorney that we're working with. In certain situations, I've seen it where the husband was kind of doing their taxes on their own, and there's errors in the prior taxes. Now we have to amend prior years. So it's kind of a group effort of getting it back together for that person. But my advice is I always encourage my clients, let's see the spouse come in so she knows who I am, that I am one of the team members, and to include the spouse who may not be, it's not their cup of tea. They don't like doing taxes.
It's not supposed to be intimidating. It has to at least be a language that they can speak.
Right. Know where it's at, who does what, and so that they're not fully surprised. And don't wait till it's too late kind of thing.
I know it's a little cheesy, but we actually use those binders that put together everybody's tax information, all of where their accounts are, a list of all the key players in the team and that kind of thing. And it's a little cheesy. Some people laugh at the little binders we put together, but at the same time, I think that does help to kind of bring everything to one place.
Definitely.
Even if it's simplified, I guess. So given that, I know there are a lot of other changes that are being proposed in the tax code. There always are, I know, but we've got the expiration of the Bush tax cuts, changes in capital gains are projected. Can you talk a little bit about a couple of those changes or proposed changes, when they might hit?
Sure. We had the extension of the Bush tax cuts at the end of 2010, and so we're fine for 2011 and 2012. The expiration is supposed to happen in 2012. It's all speculation at this point, but they're expecting to increase long-term capital gains rates from 15% to 20%. They're expected to eliminate our qualified dividend rate, so that means our dividend income is now going to be taxed as ordinary income, the same as like interest income.
So 35%, 28%, et cetera.
So you could have, so qualified dividends at 15%, so someone could jump from 15 to 35%. And if they talk about increasing the top brackets by 4%, you could have someone going from a 15% tax rate on dividend income up to 39%.
Wow.
So it's a pretty significant tax increase.
Especially if you're going to be living off of those dividends and expecting, 85 cents on the dollar, and suddenly you're getting 60 cents on the dollar.
Right.
Makes a big difference.
And the other thing they talk about is potential elimination of mortgage interest as a deduction.
That's crazy, given the market that we're in right now.
Well, they're trying to, they tier it at an income level. So they supposedly are going to phase it out for, the greater than 250 is the magic number.
Yeah.
That's debatable, but it's, whether that happens or not, I don't know. When it came back in 2009 and 10, when this was all in an uproar, I certainly had clients that accelerated sales, wanting to take advantage of what the low rates are today, and then it got extended 2 years. So when someone says, should I accelerate my sales, should I capture the capital gain now and take the 15% that we know that's out there?
Yeah.
Some people will, but who knows what happens in 2012. It's they're butting it up right next to the election year. It's a hot topic that's out there. There's a lot of talk that's what's kind of holding back the economy and why unemployment stays where it's at.
It reminds me, you said that you think that everything is fine right now, 2010, 2011, everything is fine at the moment?
Yeah, there's no speculation on any tax changes for these 2 years.
You know what FINE stands for? Freaked out, insecure, neurotic, and emotional. I think that actually applies to our economy right now. I really do.
That is it.
Yep. So, one more question, actually. Last week I read this article. It's a very exciting article for somebody like me. It was about tax diversification of assets.
Right.
And the idea that given the uncertainty in the tax code, how you might want to have some taxable investments, some tax qualified, such as IRAs, 401ks, and also some tax-free investments, Roths and life insurance. So in that way, you've got some money in different tax environments. Do you think that there's some merit to that by providing that extra flexibility? And how are you counseling clients when you look at their overall tax diversification of their portfolio?
Definitely. I mean, qualified money is typically creditor proof. They can't take that from
That's a
you.
big one. I don't think a lot of people know that.
Yeah, so it's one you don't want to tap in. That's why I hate seeing early distributions of anyone's retirement plan. It's something that people typically can't touch, so don't you touch it.
Are you seeing people take many loans from their 401ks? Not to interrupt, but
Oh, a lot.
yeah. So
Yeah.
people know that they can.
Some people don't. I mean, a lot of times that's part of the call is, hey, I need to raise money for this, and the question is, do we have a 401k? Well, there's a loan feature. We can take a 50% loan up to $50,000. It's a payback, but the interest is paid back to you.
And you're effectively an asset in your own 401k.
Right,
In that.
right.
Yeah.
So, and a lot of people don't know about it, and some plans may not have the feature in there. But it's definitely an effective way for someone to kind of cover the cash crunch that they're in without taking an early distribution.
Are you seeing many people using the cash inside their life insurance policies now, just because of the tax-free elements of that? I'm seeing a lot more people with cash value policies that are looking at using that as income right now. I didn't know if that was something that you were seeing as far as income when you're doing returns, or.
I think it speaks to the time where, income is precious.
Right, and their estates are lower, so they don't necessarily need the
That's right.
the death benefit
Right,
anymore.
with the increase in the exclusion to the estate tax.
Yeah. So what are sort of your parting words to clients these days when you talk to them about their quarterlies and just homework they might want to be doing this time of year?
I mean, it's a constant moving thing. I mean, I believe you need to work with a professional, competent professional that knows what they're doing. And it's always a moving target. And as life is always changing, so are the rules and laws always changing. And it's never a one size fits all. And what may have been good for you 3 years ago isn't good today. And it's just keeping yourself up to date and abreast of what's out there and what's new.
And you need a professional to do that. You really do.
My opinion.
Well, thank you very, very much. I appreciate you joining us today.
Thank you.
It's really been very informative and helpful. We will be back in just a minute, actually, to talk about a couple of action items, some ways that you might be able to apply what we've talked about today to your situation. I hope that you'll join us. I'm Emily Johnson. I'll see you in just a few minutes. Welcome back to Money Matters. I'm Emily Johnson, and I'd like to close today with a couple of action items, some ways that maybe we can take what we learned today or hopefully learn today and apply it to our personal situations in an actionable way. First, what we learned in the conversation with Mark, one very actionable, very easy item is taking advantage of the investment fee deduction. All you need to do is call your broker and make that change so that you're taking that fee from, instead of it being from your IRA, taking it from your taxable account. Second, consider a Roth conversion. Sit down with a CFP or your CPA and really go through the hard financials on that, determine whether or not it's appropriate for your case. And then lastly, just very generically, stay on top of all the changes in the tax code, consult your professionals. Obviously, there are some opportunities that are not necessarily a one-size-fits-all opportunity, but you need to make sure that you're abreast, because certainly if there are opportunities that fit you, you need to take advantage of them. Second, from David Kroll in our Mortgage Minute, right now is the time to buy. I love saying that, actually. But right now is the time to buy. Mortgage rates do remain low. Real estate prices remain exceptionally low. It's certainly a time to take that opportunity if you're in a position to do it and take advantage of the low interest rates and the low cost of real estate at the moment. And then lastly, based on our market overview, which I know I breezed through earlier in the show, we just have two real core action items that we'd suggest for an investment portfolio right now. The first of which is going to be consult your portfolio, determine your commodities exposure. We do feel that commodities are going to be weakening or softening or rolling over, so to speak. So take a look at your portfolio, see how you're exposed to commodities, whether you're investing in commodities directly through exchange-traded funds, perhaps even own stocks or mutual funds that are comprised of commodities. That's something to look at. One way to take advantage of it might be to short commodities. Another would be to reduce your overall exposure going forward. It's not a trend that we see happening immediately. I think it's a good mid to long-term trend that we can look forward to. And then second, I'd take a look at your portfolio in terms of financials. We've never had a market slump that didn't involve financials coming out first. We really need the financials as much as we might not like it. We need the financials to lead us out of negative times. So the Bank of Americas of the world, the Wells Fargos, the Chases, the Citibanks, everybody. We need all of the financials to lead us out. So take a look at your portfolio and consider increasing your exposure to financials. That'll probably be a place that we'll see some gains in the near future. There's always an opportunity somewhere. So that pretty much does it for us today for Money Matters. I really appreciate you joining us today. I hope that you found it informative, educational, and thank you very much to our guests. Thank you. If you have any suggestions for topics in the future, I more than welcome them, and I'd really appreciate your input. So please send me an email at the email address that's on the screen, and I look forward to hearing from you. So until next week, I'm Emily Johnson. This is Money Matters, and I look forward to seeing you then.